Income splitting rules. Whether you live in a dual income house or working with family members, it's important in Canada to understand income splitting rules. During COVID, with many small businesses relying more on family members to help out in British Columbia and Canada, it's even more important to know income splitting rules. Income splitting is simply when income from one high-earning family member is transferred to another low-earning family member to reduce tax burdens. In BC, even though the marginal tax rates are lower, this is still something that families can do to reduce taxes. Prior to 2018, a dividend from a Canadian private corporation, or CCPC, could be paid to a family member that was 18 years of age or older without any restrictions. This simply meant that the family member would be taxed in their appropriate tax bracket. Income tax brackets throughout Canada are seen in the following. So, income splitting would allow a family member that, for example, is paying 29% tax to reduce their income to only have to pay 20.5% and provide livable income to another family member who would then be paying 15% to 20% on their income. In other words, the purpose of splitting the income among family members is so that the business owner could reduce the overall tax paid to the Canada Revenue Agency. Income splitting is also referred to as income sprinkling, and would occur when some of the income of the business owner was shifted to family members whose income was less. As you can see in the table, the federal tax rate is significantly less for those earning less income. This means that, in theory, someone could cut their income in half by splitting income with a family member to reduce their income tax rate. This is just for Canada, though. Although BC does have a much lower marginal rate than other provinces, tax adds up immensely. For example, if an individual living in BC earned an annual income of $150,000, they'd be looking at a tax rate of over 40%. The table shows the marginal tax rate, that is the tax rate in addition to the federal rates seen as well, that apply to business owners and employees throughout BC. So, based on this table, if someone earned $150,000 per year in BC, they would be on the hook for 43.7% tax. However, if they split their income with a family member so they only earned $90,000 and another family member earned $60,000, the primary earner would only have to pay 31% in tax, and the other would pay only 28%, a much more manageable rate. Changes to the rules. In 2018, however, the federal government changed how they looked at income splitting. With the new rules coming into effect on January 1st, 2019, for small businesses and their families, these new rules affected some of the tax flexibilities that were offered as a result of the income splitting. This new regulation is simply an expansion of the rules for children under 18 years of age and is referred to as TOSI, or Tax on Split Income. The new rules meant that dividends paid to family members or the split income of all persons over 18 would now be taxed at the highest marginal tax rate. Essentially, the new rule takes away the ability to leverage lower tax rates by splitting your income with a family member or members in a lower tax bracket. In this context, split income includes dividends, capital gains, or any interest in the individual as an immediate family member such as a spouse, child, or sibling. It's important to note that this does not affect the salary paid out by the private corporation. Salaries that are paid out of the corporation to family members still need to be paid out at a reasonable amount compared to the work performed. The income that is now subject to TOSI include the following: dividends and shareholder benefits from a private corporation, income received from a partnership or trust where the income is derived from a related business or rental income in certain instances, income on certain debt from a private company, for example, interest, income on gains from the deposition of private shares or other property after 2017. As you would expect, there are exceptions to these new rules. These include excluded business, excluded shares, reasonable return, and an age exemption. Excluded business. If a family member is over 18 years of age and has worked for the business for an average of 20 hours per week in the current tax year, their gains or dividends are exempt from TOSI. This is provided that the income that they are earning is reasonable compared to the work that they are completing. Or if the individual is over 18 years of age and can show that they've worked for an average of 20 hours per week in 5 previous tax years. Their dividends that they receive now or in the future will generally not be subject to the new TOSI rules. It's important to note that the 5 years don't have to be in succession of each other, and they can have occurred any time in the past. It's always important that the company tries to maintain their records to reflect this employment, again, averaging out to 20 hours per week. The government may have some exceptions when the rules were initially changed, when they were looking at the previous 5 tax years referenced, though they may be less lenient going forward. As some businesses in BC are only seasonal, the family member only needs to show that they work these 20 hours per week during the part of the year that the company is operational. Excluded shares. This exemption is applicable to a family member of the business owner that is 25 years of age or older and who owns at least 10% of both the company's value and its votes. In addition to this exemption only applies if the corporation earns less than 90% of its income from the provision of services and that less than 10% of their income comes from one or more related businesses with respect to the individual. A related business includes any corporation where the individual of the business mentioned above owns shares of another corporation. The final requirement is that the shares cannot be held in a professional corporation, such as a law firm, an accounting firm, or dentist and physician clinics. More simply stated, this exemption will not apply to professional corporations. When discussing related businesses previously mentioned, this may sound like we are discussing an operating company and a holding company relationship. Typically, a holding company will generate the majority of its income from the OPCO, so it would not be allowed under this exemption. There may be different scenarios, though, where the owners can still find tax advantages. As an example, we have a holding company whose only income is from the annual distribution of dividends from OPCO, and holding company owns all of OPCO shares. OPCO meets all of the above stated requirements regarding from income services and is not a professional corporation. The holding company has 2 individuals that hold an equal number of shares in the company. One person is involved in OPCO's business while the other individual is not. The individual who is not involved with OPCO would be receiving an income from the related business noted before, so would not be exempt. Yet, if after a few years holding company sells its shares to OPCO and invests this money into a different portfolio, after 2 years both individuals would fall under the excluded shares. This is because the previous year's income would show that it did not come from OPCO, which was the related business. This may seem complicated, which is why you should speak with an accounting professional before making any decisions. Reasonable return. This third exemption is if the family member is at least 25 years of age and they receive what is deemed a reasonable value in income from dividends. The reasonable criteria include any amount of previous contribution or investment into the company, as well as any work performed in support of the business. Other criteria include any risk that is assumed by this individual in relation to the business, any amount of property that they contributed to the business, or any historical payments made by the business to the individual. The government has also included any other relevant factors as a reasonable criteria. Age exemption. The final exemption is if the owner of the business is over 65 years of age. They are allowed to split their income with their spouse, regardless of the spouse's age, and their income will not be subject to the TOSI rules. Need help from an expert? If you need clarification on how the new rules and exemptions may affect your company, let one of our experts at Valley Business Center help. For over 30 years, Valley Business Center has been providing comprehensive bookkeeping, payroll and tax services to our clients in Whistler, Squamish, the Sea to Sky Corridor, and Metro Vancouver, BC areas. Valley Business Center provides reliable and effective services to all of our clients. If you like this topic and want to hear more, please click the like button now and hit the subscribe button to get more helpful information. Thanks for watching.